Welcome to Illuminati Silver. We tell the truth about silver. Today is Thursday, the 6th of August 2020. And as yesterday was my birthday, I took the day off. Now on Tuesday, we published a video entitled Gold Hits $2,000 and Silver $26, where we published reports suggesting the precious metals still have further to run. Well, they certainly did have further to rise, and at the time of producing this video, which is close to 2200 hours GMT+1, gold is standing at $2,063, having actually touched $2,070 a short while ago. This is a rise of some $24 or 1.2%, and silver is currently $28.94, having passed the $29 level at $29.11, and is currently up $1.92, a rise of a significant 7.11%, and a gold to silver ratio just above 71:1. Now today we're going to talk about gold and how some experts claim it is now expensive, but actually is still, despite this, likely to rise even further. And tomorrow we shall do a thorough analysis on silver. So we'd like to read a Bloomberg article published earlier today, highlighting why, despite gold being expensive, can still rise, and a Reuters article providing us with some updated other financial information and market data. Let's take a look. Bloomberg article dated August 6, 2020 at 5 o'clock a.m. GMT+1. So this was a number of hours ago. Headline: Gold is expensive and may be just warming up. History shows that once the price rises above fair value, it has a tendency to keep going. Answering an impossible question. As I write, gold has surged to yet another record, topping $2,050 per ounce. Freudian slip there, 20,000. Is it overpriced? The question is impossible to answer. Gold's value rests in the eye of the beholder, and over recorded human history, people have continued to find it beautiful. It pays no income, and its intrinsic value is set by the market. Valuation techniques that work for other assets won't work for gold. The fact that we will never scientifically arrive at a correct price need not stop us from trying, however. And after going through the various valuation exercises, the rally looks rational. While the current price looks expensive, it could easily rise further. One way to measure gold is to compare it to other commodities. Back in the 1970s, the oil price shocks could be seen as a way for petroleum exporters to keep the value of their product constant in gold terms once the dollar's peg to the metal had ended. On this basis, gold looks expensive. The ratio of oil to gold, or the amount of metal it would require to buy a barrel of crude, hit its lowest since the peg's end earlier this year as oil tanked. There has been a rebound since, and a further recovery for oil would help gold. But the shiny metal is plainly not cheap on this basis. Another possibility is to look at money illusion. The gold price in dollars depends on the value of the currency as much as on the value of the metal. The dollar has weakened sharply in the last few months, but if we look at gold in euro and yen terms, there is more to this than dollar weakness. Gold hit an all-time high against both these currencies last year. It is currently at a record in all three. Then we come to the issue of inflation. Gold is seen as a store of value. This value will naturally tend to rise when people expect inflation ahead. On this basis as well, gold might initially seem overpriced. The Federal Reserve has received a lot of deserved criticism for its handling of the US economy over the last 2 decades. But on one important measure, it has been undeniably successful. Nobody has ever thought that inflation will take off. The Fed's target is to keep inflation between 1% and 3%. Since 1998, 10-year inflation expectations derived from the bond market have never exceeded 3% and have dipped below 1% only very briefly. Inflation expectations have been rising fast following the COVID shock, which helps explain the rise in gold, but remain at a level that makes an all-time high look hard to justify. But now we come to the most important influence on gold, which is the real yield available on bonds. Gold doesn't pay an income, and this becomes less and less of a problem as bonds pay less in real terms. At present, real 10-year yields are more negative than they have been since inflation-linked bonds became widely available. One crucial development of the last year is that the US has joined Germany in having very negative real yields, which presages a weaker dollar as well as higher gold prices. Real yields form the backbone of one of the more interesting models of fair value for gold, produced by City of London veteran Charles Morris, the founder of Buytree.com. The model described here is essentially a zero coupon 20-year Treasury inflation protected security, or TIPS, and thus rises as long-term real yields fall. In brief summary, the factors included are major factors: realized inflation, real interest rates 20-year expected, speculative premium and discount. Minor factors: US dollar, consequences rather than cause, central banks, wars, bad news, jewelry demand, counter-cyclical, and mine supply. Here is how the model's fair value has compared to the actual gold price over time. The key points are that fair value has risen sharply to reach its previous record in recent weeks, and that the actual price is significantly higher. The premium as of early trading August the 5th was 23.7%. This chart shows how the premium discount to fair value has moved over time. The point for a trader is that when gold is in a bull market, it has shown a propensity to move even further above fair value. So gold is expensive, but it is still significantly less expensive than at the previous peak in late 2011. For those wanting to play the dangerous game of predicting a speculative surge, Morris offers another important data point. Equity bull markets tend to peak when retail investors are sucked in, a process that appears to be happening for stocks. The same was true for gold during its massive peak in real terms in 1980, when news bulletins were full of footage of people happily emerging from shops having converted their life savings to a small pile of gold sovereigns, transactions that would have taken decades to work out. And again in 2011, the weight of gold buying through exchange-traded funds reached a high. This rally has plainly been fueled by something other than ETF buying. The bullish scenario is that central banks keep doing what they're doing, squashing real yields ever lower and continuing to raise the fair value for gold. Then inflation at last begins to come untethered and rise towards or even above its upper 3% target, which is conceivable but still some years away. And then retail buyers enter in a big way. A while after this, gold would probably go splat, but the ride to get there would be lucrative. The risks would come in change of central bank behavior, just as the last gold peak turned into a bear market once the Fed started to try to move away from its unlimited asset purchases. Such a change looks less likely this time. Gold does look expensive then, but there is little reason to expect it to fall much anytime soon. Reuters article dated August 6, 2020. originally written at 12:45 a.m. GMT+1, but updated 5 minutes ago, which was about 21:45 GMT+1. New York. Global equity markets edged higher and bonds yields eased off earlier lows on Thursday as investors awaited word on a new US aid package to counter economic fallout from the coronavirus crisis. Safe haven gold extended its record-breaking run, driven by expectations of more stimulus, while the dollar initially gained after data showed fewer Americans sought jobless benefits last week. Gold has been rising on concerns stimulus will fuel inflation and erode the value of the dollar. Initial claims for state unemployment benefits fell 249,000 to a seasonally adjusted 1.186 million for the week ended 1st of August, the US Labor Department said, the lowest reading since mid-March. Revised data for June showing payrolls jumped by 4.314 million jobs instead of adding 2.369 million as previously estimated, cheered investors who see a stronger economy than those who fear the economic impact of a surge in COVID-19 cases. A proper economic recovery is still far away, said Jeffrey Christian, managing partner of CPM Group. There are mixed signals that the economy is recovering, and some of the signs of recovery are relatively superficial, as they show aggregate figures and not how medium and small enterprises continue to suffer, Christian said. More than 1 million initial claims a week is not desirable if you think the economy is recovering, said Youssef Abbasi, global market strategist at StoneX Group, Inc., in New York. The report, he said, supports the need for stimulus. It puts us right where the Fed wants to be, right where you'd want to be if you're thinking Washington needs to get stimulus done, Abbasi said. You don't want them to be too encouraged by better data to slow their approach. Republicans and Democrats remain far apart about what to include in another wave of relief after nearly 2 weeks of talks on next steps to address a crisis that has killed more than 157,000 Americans and thrown tens of millions out of work. The relief bill should be more targeted than the first to preserve ammunition if another shutdown should require further aid, former Reserve Bank of India Governor Raghuram Rajan told the Reuters Global Markets Forum on Wednesday. The major US stock indices traded little change, but bourses in Europe fell as a 3-day rally ran out of steam. Treasury yields fell, with the 10-year note sliding to 0.504% at one point, its lowest ever after a big down spike on March the 9th. The euro climbed to its highest against the dollar since May 2018 before pairing some of the gains. The weak dollar, strong euro trend will continue into next year, a Reuters poll showed. On expectations, the US economic recovery is flagging, especially compared with Europe. The dollar index ended the session essentially flat, while the Japanese yen strengthened 0.03% versus the greenback at 105.53 per dollar. The British pound rose to a 5-month high against the dollar after the Bank of England left interest rates at 0.1% and warned about possible risks from taking rates below zero. Spot gold hit an all-time high of $2,069.21 an ounce and was up $24.1813 or 1.19%. Oil prices hovered near 5-year month highs as support from a weak dollar equals USD and falling US crude inventories countered bearish sentiment on fuel demand. Okay, so the dollar, though weak, is little changed today. US equity bourses are up a little, around 0.5%. Now, a number of technical analysts are predicting that gold could rise to between $2,081 and $2,100 tomorrow on the upside, or we could see it fall back to $2,000 on the downside. We have the non-farm payrolls report tomorrow, which could have an interesting effect on prices. Interestingly, it's been so long since silver has been at these levels, some, in fact many technical traders, have little recent data on which to base their assessments, and we can fully understand that. There is a suggestion that $29 will be highly resistive, though we have seen it surpass that, though it's come back a little since then, and that $27 is now strong support. But we shall cover this in more detail tomorrow, and hopefully we'll get that video out earlier in the day. Meanwhile, share your thoughts. Let us know what you think and where you believe silver is going to end up, not just this week, but perhaps, let's say, by the end of the month or by the end of the year. It'll be interesting to make those assessments. And equally with gold, is it expensive or has it much further to run? We'd like to hear from you. Thank you so much for listening. If you haven't already done so, please subscribe to our channel and press the bell sign so that you're notified of our videos as and when they're published. Not forgetting that we also update our Richard and Greg channel every sort of 3 or 4 days, and we have published part 2 of our mini-series, Who is Greg? Just highlighting a little bit about controversially Greg's life. If that's of interest, please go over to that channel. If not, then do not listen to it. Thank you. Until tomorrow. We hope you have found this video interesting and informative, and if so, please give it a thumbs up and share it on social media. Please ensure that you have subscribed to our channel and press the bell sign so that you are notified of any future videos. Also, kindly visit our website at illuminatisilver.com, and if you haven't already done so, please subscribe either as a free or paying member for regular email updates and offers. Disclaimer: Illuminati Silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners.